Hello everyone, and welcome to another video. In this video, we'll be discussing breaker blocks and how you can utilize this concept to enhance your chart analysis. We'll cover the definition of a breaker block, delve into the psychology behind them, and explore why they are effective. Additionally, we'll explain methods to identify and trade them. If this topic piques your interest, kindly support us by hitting the like button and subscribing if you're new. Now, let's explore the concept of a breaker block. A breaker block is essentially a failed order block that transforms into another supply or demand area on the chart. As per basic price action principles, when the price breaks through a resistance level, it typically becomes a support level due to market participants' behavior. Similarly, when the price breaches a support level, it tends to act as resistance upon revisiting that area. This same principle applies to order blocks as well. The market might overlook the supply and demand of an order block for various reasons, such as changes in market structure, overvaluation or overselling, tapping into higher time frame key levels, and more. When a legitimate demand order block fails to reject the price, causing the price to break through it, it transforms into a supply level. This type of block is referred to as a breaker block, with the expectation that the market will reject price movement in this area. This is an example of what a bearish scenario might look like. The structure breaks above the higher high with inefficiency, creating a valid order block zone that offers a long opportunity. However, the market undergoes a change of character due to an aggressive move breaking below the previous low. Consequently, the directional bias shifts to bearish, and our demand level will now act as supply after this break. The psychology behind the breaker blocks lies in trapping traders who went long in the order block, making them wait for the price to return to their break-even point to close their long positions without a loss. Additionally, other traders will go short in this area, perceiving it as a key supply zone. The outcome of this double action leads to a price reversal from this particular area. A crucial point to note is that a breaker block forms when there is a run of liquidity before a market structure shift. Similarly, in a bullish scenario, we need to observe a liquidity run below the swing low before a market structure shift higher. We identify the candles that created inefficiency and extend them in time to form our breaker block, expecting the price to reject that area. On the chart, there was a strong bullish movement that resulted in inefficiency and a break of the market structure. Consequently, a valid order block emerged which represents an excellent demand level for taking long positions. However, the market suddenly changed direction and broke below this demand level with large candles. This change in direction might be due to the price tapping into a higher time frame resistance level. On the 15-minute chart, this move was seen as a liquidity grab above the previous highs. Now, we have a shift in market structure to bearish, and the previous demand area has now become supply. Therefore, we expect the price to be rejected from this breaker block and continue moving downwards. On this chart, an order block creating inefficiency and breaking the structure was identified. However, the market broke below this demand area, showing a bearish market structure shift. As a result, the demand zone turns into a supply area, potentially providing a short trading opportunity if the market taps into this zone. Now, let's discuss some crucial factors you need to consider while trading breaker blocks. Now, let's move on to the key factors. Firstly, market structure. It's essential to identify the current market structure before searching for breaker blocks. This involves defining the market direction, supply and demand areas, higher time frame key levels, liquidity areas, and the available space ahead of the price. Secondly, validity. Ensure that the breaker block you identify is valid. These blocks emerge from a run of liquidity before the market structure shift. Look for a sharp move with fair value gaps between the wicks, creating inefficiency. Thirdly, confirmation. Exercise patience and wait for confirmation before entering a trade. Confirmation can come in various forms of price action signals. For instance, shrinking candles indicate waning momentum as the price approaches the breaker block. Additionally, watch for a long wick candlestick that strongly rejects the area. Furthermore, observe a change of character that confirms the direction change and suggests a possible reversal. By keeping these factors in mind, you can effectively trade breaker blocks and enhance your likelihood of success. It's important to use breaker blocks in conjunction with other forms of technical analysis when making well-informed trading decisions, much like with other trading concepts. I appreciate if you like and subscribe. We are going to be back with new content very soon.